Good afternoon, everyone. Welcome to the Market Voice. In trading, one of the most important topic is risk management, and in spite of it being such a vital factor for our survival, very few people have really understood the concepts of the risk management. What exactly is the risk management? The concept of risk management that we read in textbooks, it could be systemic risk or non-systemic risk, factors that are affecting the probabilities. All of those things a market participant or a trader do not really understand fully, and he doesn't know how to map the concepts of risk management that is taught in any financial literature on how to map it to our trading activities. Many people associate, or when they talk of risk management, what they are actually talking of is risk and reward management. Many people don't even know risk is certain. We can define the risk of our trades, which means we can define how much we are ready to lose on a particular trade, and we can stick to that plan except for certain slippages which is not in our control. When the stop loss hits, it might trigger the stop loss and there might be certain slippages, but at least we can account for our quantum of risk. We can predefine the risk, but when it comes to the reward, we do not know how much the market gives us, which means the reward portion is a uncertain factor. It is a variable. Risk is a constant which we can define, and reward is something, it is a variable which we cannot define beforehand. Or even if we define a reward, say 1:2, so I take 1 rupee risk and I want 2 rupees reward. Market may give more than 2 and we may fail to capture it. So when you talk of risk management, or when you are formulating your risk management policies or rules, do not involve the reward portion as part of your risk management. Many people don't even know they should not be involving reward portion as part of the risk management. That is why many a times the traders use the stop losses. Along with the stop losses, they use the targets. But I never provide any targets, because targets are not determined by us. Targets are determined by the market movement. So target can be anything. Why to be why to preempt the market movement by our targets? Markets can continue to go much higher than our target levels, or it might even top out much before our target levels. Do not anytime take into consideration the target levels, but when you are checking the strategies plus and minuses, even if the strategy closes with 1 rupee plus, please consider that as a positive trade and not as a negative trade. So that way what happens, when you are doing any strategy, when you are checking or back testing your strategies, when you have to determine what is your success ratio or what is the probability of your trades that are ending in positive, you have to consider only the risk which you can define with your own mindset, or with your own capital, or with your own risk appetite. So all that matters in trading is defining our risk and not attaching our risk with respect to the rewards that might come from the market. When you formulate your risk strategies in this way, your success ratio improves a lot, because you will start working on the strategies and start checking why the strategy is not being in profit. It's not you being 50% above or 30% above. It's not out of 10 trades you have to make 5 trades. Even if you are making 3 to 4 trades right and 6 to 7 trades wrong. If when you are right, if your strategy is giving you more than each time when it is wrong, then you have a very good strategy and you have to just work on that strategy without worrying about or fixing your reward saying 1:2 or 1:3 or 1:4. This is not the exact science. Even in the proper, maybe when you are in the finance literature, whether you are doing BCom or CA or MBA or whatever, what they teach about the risk management, they never talk of the reward, which is a variable component. With that respect, here our objective in this market voice is we are seeing the wisdoms from the book called The Art of War, as written by SunTzu 2500 years ago. What does he talk of in this aspect? In fact, in the 4th chapter, Tactical Dispositions, in the very second treaty he tells, to secure ourselves against defeat lies in our own hands, which means to secure ourselves against defeat lies in our own hands, but the opportunity of defeating the enemy is provided by the enemy only, which means the risk to secure ourselves, to protect ourselves from the big drawdowns, to protect ourselves from big blow ups, we can define what is the risk that we can take and we can stick to that. But what the market gives or winning against the enemy is not just in what our own strengths, we have to also allow the enemy to make the mistake. Here the market participant, only when he makes a mistake we will get the money, but if we make the mistake then we will lose the money. So not making a mistake is in our hands, but the opponent, the other market participating person, whether he makes a mistake or not is totally in his hands. So always remember, when we talk of risk management, we have to talk only of the risk portion and not the risk and reward portion. The commonly made mistake by all the traders is they look into the risk and reward ratio, which should not be done. Well, having said that, let us